Investing in the stock market may seem daunting at first, but with the right approach, it can be an effective way to grow your wealth over time. This guide will walk you through the basics of stock market investing, helping you understand the key principles and offering practical tips to get started. 1. What is the stock market? The stock market is a platform where shares of publicly traded companies are bought and sold. Companies sell shares to raise money, and investors buy these shares hoping they will increase in value over time. Essentially, owning a share means you own a small portion of that company. When the company grows or becomes more profitable, the value of its shares typically increases, allowing investors to make a profit. 2. How does the stock market work? The stock market operates through exchanges, such as the New York Stock Exchange, New York Stock Exchange, or NASDAQ. These exchanges act as a marketplace where buyers and sellers meet to trade stocks. The prices of stocks fluctuate based on supply and demand. If many investors want to buy a particular stock, its price will go up. If more investors are selling than buying, the price will go down. Investors make money in two ways. Capital appreciation. When the price of the stock you own increases over time, you can sell it for a profit. Dividends. Some companies distribute part of their profits to shareholders in the form of dividends. This can provide a steady income stream. 3. Why should you invest in stocks? There are several reasons why investing in stocks is a good idea for building long-term wealth. Potential for high returns. Historically, the stock market has provided higher returns than many other types of investments, such as bonds or savings accounts. While there's always some risk, over the long term, the stock market has trended upwards. Ownership in companies. When you buy stock, you own part of a company. If that company does well, you benefit from its growth. Passive income. Through dividends, some stocks can provide a regular income even without selling the shares. 4. How to start investing in the stock market. Getting started with stock market investing is easier than you might think. Here's a step-by-step guide. A. Set your financial goals before you start investing. It's important to define your goals. Are you saving for retirement, buying a house, or building a college fund for your children? Knowing your goals will help you determine your investment strategy and timeline. B. Create an emergency fund before diving into stock investing. Ensure you have a safety net. Create an emergency fund that can cover 3 to 6 months worth of living expenses. This fund will protect you from having to sell investments at a loss in case of an unexpected financial crisis. C. Open a brokerage account. To buy stocks, you'll need a brokerage account. This is an account that allows you to purchase and hold investments like stocks, bonds, and mutual funds. Some popular online brokerages for beginners include Robinhood, Fidelity, E-Trade. Charles Schwab. When choosing a brokerage, look for one with low fees, a user-friendly platform, and educational resources for beginners. D. Start with index funds or ETFs. If you're new to investing, buying individual stocks can be risky and overwhelming. A safer option is to invest in index funds or exchange-traded funds, ETFs. These are collections of stocks that track a specific market index, such as the S&P 500. Index funds offer diversification, meaning your money is spread across many companies, reducing risk. Diversify your portfolio. Diversification means spreading your investments across different types of assets to minimize risk. Don't put all your money into one stock or sector. By diversifying, you can reduce the chances of losing a large amount of money if one stock or sector performs poorly. F. Invest regularly and for the long term. The key to successful investing is consistency. By investing a set amount of money regularly, such as monthly, you can take advantage of dollar cost averaging. This strategy involves buying more shares when prices are low and fewer when prices are high, which can lower the overall cost of your investments. It's also important to invest for the long term. The stock market can be volatile in the short term, but historically, it has grown over time. Avoid the temptation to panic sell during market downturns. 5. Types of stocks. There are different types of stocks you can invest in, and understanding the distinctions is important for building a well-rounded portfolio. Common stocks. These represent ownership in a company and typically come with voting rights. Most investors own common stocks. Preferred stocks. These don't usually come with voting rights, but they do offer fixed dividends. Preferred stockholders are paid before common stockholders in the event of liquidation. 6. Risks of stock market investing. While stock market investing can offer high returns, it's important to understand the risks. Market risk. The value of stocks can fluctuate based on market conditions. Economic downturns, political events, or company-specific issues can lead to significant losses. Volatility. The stock market is volatile in the short term. Prices can swing up or down dramatically, which can be nerve-wracking for new investors. Company-specific risk. If the company you invest in performs poorly, the value of your stock can decrease, potentially leading to losses. To mitigate these risks, it's important to diversify your portfolio, invest for the long term, and avoid panic selling during market downturns. 7. The importance of research. Before investing in any stock, it's important to research the company thoroughly. Look at its financial statements, earnings reports, and future growth potential. Tools like Yahoo Finance, Morningstar, and Seeking Alpha provide valuable information for evaluating stocks. Also, consider the company's revenue growth. Is the company increasing its sales year over year? Profit margins. How efficiently is the company converting revenue into profit? Debt levels. High levels of debt can be risky if the company experiences financial difficulties. Competitive advantage. Does the company have a unique product, service, or market position that sets it apart from competitors? 8. Stock market strategies for beginners. When starting out, there are a few basic strategies you can follow to maximize your chances of success. Buy and hold. This strategy involves purchasing stocks and holding them for the long term. It's based on the idea that, over time, the market will go up, even if it experiences short-term declines. Dividend investing. This strategy focuses on buying stocks that pay regular dividends. It's a great way to earn passive income, and many dividend-paying stocks are also stable, well-established companies. Growth investing. Growth investors focus on companies that are expected to grow at an above-average rate compared to others. These stocks may not pay dividends, but they offer